Hello and welcome to LM Reads. I'm a researcher who loves to break down fascinating books for you. Today, we're diving into one of the most influential documents of the 21st century, Satoshi Nakamoto's original Bitcoin white paper.
Back in 2008, this was a huge deal. This was a totally radical promise, a completely new vision for how money could work on the internet.
So, that brings us to the big question, right? 16 years have passed. Is that what Bitcoin actually became? That's what we're going to dig into today by comparing that original vision with the reality of Bitcoin on the ground.
All right, so to really get what Satoshi was going for, you have to understand the core problem he was trying to fix, and it all comes down to one word: trust. Think about it. Before Bitcoin, anytime you bought something online, you were forced to go through these middlemen, right? Banks, credit card companies. And they brought all sorts of baggage, extra costs, the risk of fraud, and you could never really have a final, irreversible payment. What Satoshi wanted was simple: a system that worked just like handing someone physical cash, but for the digital world. No takebacks, no middlemen.
Okay, but here's the massive roadblock, the thing everyone was stuck on. It's called the double spending problem. See, with digital stuff, you can just copy and paste it, right? So how on earth do you stop someone from spending the same digital dollar over and over again if you don't have a bank keeping a central ledger of who owns what?
And this is where the genius of the white paper really shines. Satoshi's solution was this beautiful, elegant engine built from a few key pieces of tech. So let's pop the hood and see how this thing actually creates trust without needing a central authority.
The heart of the whole thing is the blockchain. And really, the best way to think about it is as a public digital receipt book. The really cool part? Once something is written in this book, it's pretty much impossible to erase it.
So how does your transaction get into this unerasable book? Well, it's a multi-step process. The whole point is to get this massive, decentralized network of computers to all agree on the same version of history, to reach a consensus without any single boss in charge.
Now, the secret sauce that makes this all secure is something called proof of work. Honestly, just picture a giant, never-ending lottery. You have these miners with super powerful computers, all competing to solve a really tough math puzzle. The first one to solve it gets to add the next page of transactions to our receipt book. All that energy they burn, all that computational power, it's like the digital equivalent of a gold miner spending real resources to dig gold out of the ground. It's what makes the history of transactions so incredibly hard and expensive to change.
Okay, so we have this incredibly secure system for peer-to-peer cash. But this is where the story takes a fascinating turn. Because while the white paper's title is literally a peer-to-peer electronic cash system, that's not really how most people see Bitcoin today.
You see, the original dream was all about using Bitcoin for everyday stuff, small, casual transactions, like buying a coffee. But over time, a completely different narrative has taken over. Bitcoin as digital gold, a store of value that's meant to protect your wealth from things like inflation. And let me tell you, this isn't just some polite academic debate. The community is fiercely divided on this. People have really strong feelings about what Bitcoin's true purpose is. Is it cash or is it gold? The argument gets to the very soul of the project.
And this whole digital gold story has had a huge real-world consequence. We're now seeing major corporations, we're talking publicly traded companies, stacking Bitcoin on their balance sheets. Let's look to who's doing it.
The company that really kicked this whole thing off was MicroStrategy. They didn't just dip their toes in, they went all in, converting a massive chunk of their company's treasury into Bitcoin. And the amount they hold today? It's just mind-boggling.
And why did they do it? Well, their CEO, Michael Saylor, put it pretty bluntly. He famously said that in today's economic climate, holding cash was like watching a melting ice cube. He saw Bitcoin as the solution.
And, MicroStrategy is not some lone wolf here. You've got companies like Block, run by Jack Dorsey, doing the same thing. They see it as part of building a better, more open financial system. So the big takeaway is this. What used to be a really fringe, out-there idea is now a serious strategy being discussed in corporate boardrooms.
So, where does that leave us? And is this short, 9-page paper from 2008 actually worth your time to read today? My answer is a resounding yes. Absolutely. Look, it's so much more than just a dry technical document. This paper is basically the birth certificate for a new kind of money, the blueprint for a radical economic experiment that's now a global phenomenon. The only way to truly get what's going on with Bitcoin today, why it evolved from cash to digital gold, and why people argue so passionately about it, is to go back to the beginning and understand Satoshi's simple, elegant vision. Which leaves us with a really fascinating question to ponder.
The business of Bitcoin. We're going to look at everything from your local corner store all the way up to the biggest corporate boardrooms. Okay, so let's get right into it. We're going to break down what it actually means for businesses, both big and small, to start using Bitcoin. We'll start with the little guys and then scale way, way up to the giants of the industry. All right, first things first. Let's put ourselves in the shoes of a small business owner. You run a coffee shop, a bookstore, whatever. How in the world do you even begin to accept Bitcoin from your customers? Well, it basically comes down to these 3 steps. First, you need some kind of payment processor, right? Something to actually handle the transaction. Then you need a digital wallet, a place to keep the Bitcoin you get. And finally, you've got to connect it all to your checkout system, your point of sale setup, whether that's a cash register or an online store. But why go through all that trouble? Well, the perks can be pretty huge. For starters, you're opening your doors to a whole new crowd of customers. And get this, because crypto doesn't care about borders, selling something to a customer halfway across the world, it's suddenly just as easy as selling to your neighbor. Plus, these transactions, they can be super fast.
Okay, but it's not all sunshine and rainbows. There are definitely some risks. The regulations, they're changing all the time, and that's a headache to keep up with. And then there's the price. It's famously volatile. That $100 in Bitcoin you made at 9 a.m. could be worth $85 by lunchtime. And on top of all that, you've got this new tech you have to figure out. All right, let's shift gears. Big time. We're leaving the local coffee shop behind and stepping into the corporate boardroom. We're not talking about a few $100s anymore. We're talking about billions. And this quote from Michael Saylor, the CEO of MicroStrategy, just hits the nail on the head. He said his company's cash was like a melting ice cube. This really captures the massive problem that huge public companies were facing, especially after 2020. The whole economic landscape was shifting under their feet. Think about it. With inflation kicking in and interest rates basically at 0, if you're a big company sitting on a giant pile of cash, you're actually losing money every single day. The purchasing power is just draining away. So the people in charge of that cash, the corporate treasurers, they had to get creative. They started looking for a new place to park that money, and a few of them landed on something pretty radical: Bitcoin. Now, this slide is so important because it shows a massive roadblock that just got cleared. It's a total game changer. See, under the old, kind of weird accounting rules, if a company bought Bitcoin and the price dropped, they had to report that loss. But if the price shot up, they couldn't say a thing about it on their books until they sold. It was like they could only report the bad news. This new rule, the fair value rule, changes everything. Now they can report both the gains and the losses, which gives everyone a much clearer, more honest picture of what's going on. So with that accounting hurdle gone and all that economic pressure building up, it was like a green light for some of these trailblazing companies. You see firms like MicroStrategy and Block saying, okay, let's do this. And they didn't just see Bitcoin as a way to take payments. They started viewing it as a fundamental part of their financial strategy, a place to store their company's wealth. And the amount of money we're talking about is just mind-blowing. By early 2024, we're talking about public companies holding billions of dollars in Bitcoin. And just look at the leader, MicroStrategy. They held over $15 billion worth. I mean, they didn't just test the waters, they did a cannonball into the deep end. Okay, so we've seen a small shop and a giant corporation using Bitcoin. But for any of that to be possible, there's this massive global network humming along in the background 24/7. So the big question is, who's actually running the show? What powers this whole thing? It really comes down to 2 key groups. You've got the miners, who you can think of as the powerhouse, the engine room of the whole network. They're doing the heavy lifting to secure all the transactions. And then you have the node operators. They're like the independent auditors, the rule checkers, making sure nobody's cheating the system. And just to be clear, when we say miners, I don't want you to picture some person with a laptop in their garage. No. We are talking about colossal factory-sized data centers. These places are packed with specialized computers, they need an insane amount of electricity, and they have these giant industrial cooling systems just to stop everything from melting. And here's the thing about those computers. They're not like the one you're using right now. They're called ASICs, and that stands for Application-Specific Integrated Circuit, which is just a fancy way of saying they're built to do one and only one thing:
mine Bitcoin. They are unbelievably good at that one job and totally, completely useless for anything else. Then you have the other group, the node operators. And this is totally different from mining. Just about anyone can run a node with a regular computer and an internet connection. What they do is download the entire history of every Bitcoin transaction ever. It's called the blockchain. And their computer independently checks that everything adds up. This is the secret sauce. This is what makes the network decentralized and keeps it honest. Okay, so as Bitcoin starts to become a normal part of the economy, you've got this fascinating problem. The old rulebook for money just doesn't work. So right now, accountants and regulators are in this mad scramble trying to figure out how to jam this new round peg of digital technology into the old square holes of traditional finance. And this chart, it shows you exactly why that's so hard. From an accountant's point of view, Bitcoin is absolutely not cash. And why not? Well, cash is defined as actual currency, it's backed by a government, and it's legal tender. Bitcoin is none of those things. It's a digital asset, its value comes from people agreeing it has value, and it's not official legal tender almost anywhere. So if it's not cash, then what is it? Well, the accountants have decided to call it an intangible asset. That puts it in the same bucket as things like a brand's trademark or a patent. And what that really means is they see it as a long-term investment, not as cash you can use to pay the bills tomorrow. And this is where it gets wild, especially for investors. Remember that fair value accounting rule we talked about? Because of that rule, all these crazy price swings, they now show up directly on a company's official earnings report every quarter. So if Bitcoin has a great quarter, the company reports a massive paper gain. If it crashes, they report a massive paper loss, which introduces a ton of volatility into their profits. And you can imagine this all lands with a thud on the desk of the chief financial officer. They're basically having to write a whole new playbook. Suddenly their job includes managing these insane swings in their earnings reports, building Fort Knox-level security for their digital assets, trying to explain all this to Wall Street investors, and figuring out how to make a public ledger talk to their own private books. It's a massive challenge.
So that brings us to the big final question. As Bitcoin makes this journey from a weird fringe idea to a line item on the balance sheets of major corporations, are we just watching them add another asset to the portfolio, like gold or real estate? Or is this something bigger? Are we actually witnessing the first chapter in a total rewrite of the rules of finance itself? That, right there, is the multi-trillion-dollar question.
Let me know in the comments if this makes you want to pick up the book.